As I said, in tax world, everything changes. So we want to know what is going on in year 2024. Even though it is election year, a lot of time during election years, the tax changes are coming more heavily. The reason is people knows for the past 4 years how the rules and regulation goes. So there's litigation, settlement, a lot of movement would coming in right before election. Of course, the election comes in, maybe changing the White House will trigger certain taxes to be different. So there is incentives for people to settle a lot of things and getting through a lot of things in the tax world. So today what we did is to look at what happened from January to June and figure out the element that related to our small guys, small business owners. Not all the things happens in the tax court or in the circuit court. It has anything to do with you. You may not even need to know that part of knowledge. But what we did here today for our clients, our follows community CPA, we bring to you that is the relevant knowledge to you. So let's get going. So our topic today is what is happening in tax world. Anything small guys should know, right? And of course, it is our routine, right? Every time we talk about what needs to be done, and we introduce ourselves to you, because you may wondering, hey, what bring you here? Who you are, Ying, and tell me about you. So I am the managing partner for Community CPA. Our firm has 27 years practice history, and we started back in 1998 from one client, one person, which was me, and to today we have 40 professionals, 5 different branches located in 4 different states. Our newest one is in Houston, Texas. So that kind of gives you the journey of our firm, where we're going. Obviously, you may say that, well, between Des Moines, Iowa City, Iowa, Minnesota, Bloomington, Capitola, California, and what leads you to go to these places, and what is your community CPA's path? Our path is our client's path. So when we have more clients in a concentrated area, that's where we open up a physical branch. So that's why Houston, Texas is there. And I am the CEO, managing partner for Community CPA. I served on the National Taxpayer Advocacy Panel for 3 years. That is the Federal Advisory Committee to IRS. So give you a little bit of bragging of my background to settle your mind, knowing that you are not listening to someone who doesn't know taxes. And here I wrote 2 books. I am the author for these 2 books, and I am writing the 3rd one. 8 a.m. to teach everyone how to start up a business. The 10 a.m. to share experience of our firm and our clients how to grow the business. Of course, the 2 p.m. is the one I'm writing. That one is expanding the business. Then 6 p.m. retiring from the business. So it's a journey of a day, but representing the journey of the business. No responsibility disclaimer, very important. You learn what you learn, but verify it, apply it wisely. That is the way to be successful in any business. Am I right? All right. So today's webinar, it is following an article on Accounting Today. Accounting Today is the largest accounting publications, and accountants and CPA firms are following. And our firm just recently received the recognition. We are one of the 10 most advanced technology CPA firm in the country. So Accounting Today manages the understanding, the growth, the trend of the CPA firms. They have published an article on July 16th, which is called 2024 at the Half, What Has Been Happening in Tax. So we take that article, looked at what they selected on the cases, then I went in to look into the case and I come up with a shorter list, still not very short. We have a very, very heavy content today. And I came up with a list that related to our small business owners and the people like you and me. And normally your CPAs, your tax preparers, should have reflected on these knowledge. They should bring these changes to their dealing with you. But I want you to understand that not everyone have that resources to do so. So for my followers and clients, I use this list to learn, and I learn with you today. And we want to stay on top of everything, and we want to know what is the leading interpretation, understanding of tax laws or publications from IRS, what is important to us, right? So in this hour, I will walk you through a list of items that small businesses should know. All right, let's get going. Corporation owner's income. This is a court case. The tax court issued a bench opinion regarding the treatment of uncashed checks for tax reporting purposes. This is a state versus commissioner. So every time you see a name versus commissioner, you know that it is a court case that, basically the company maybe get audited. And after get audited, the auditor, IRS assessed how much they owe. The company disagreed, so would file into two appeals. But when the appeals goes yes or no, and it did not agree, then the taxpayer can go to tax court. When the tax court said yes or no, taxpayers still don't agree, it can go to circuit court. So these are the things we pull from different areas and to just tell you what happened to the case. So in this particular case, the company had a uncashed checks, which is the owner's income. That happens a lot, right? In a small business, the business owners, they write checks to themselves as their salary, as their income, but the money just not there in the bank account. So what did the business owner do? They don't cash it, right? They keep it. Now, when the business owner reporting his own W-2, his own 1040, should this business owner report the income or not? Because he did not cash it. This is the court case. Just got resolved within this 6 months time. So here, what it is. Signed versus unsigned checks. So the tax court issued an opinion. The tax court required the corporation owner to report signed but not cashed checks as income. You hear me, right? This decision was based on the principle that the signed check represents a commitment to pay, are considered income when issued, regardless whether they have been cashed or not. What about unsigned checks? In contrast, the court determined that unsigned, uncashed checks did not need to be reported as income. The rationale was that without a signature, there was no enforcement obligation to pay. So therefore, it does not represent income until it is actually executed, right? What about is unsigned checks, but withholdings are already done? In this case, the court decided that the checks themselves would not be constitute as taxable income until it's signed, but if it is tax already withheld, unsigned check could be reported only to the extent that any withholdings had been paid over, which means that you have unsigned check, but withholding is already paid, that already constitute your income. So that is a new court case, right? Just concluded. Tax court already gave opinions. So ladies and gentlemen, if you have a corporation and you write checks to yourself as income, as long as you sign it, that is your income regardless you actually cashed it or not. Makes sense? All right, let's go to the next one. NOL dating back 15 years. What is NOL? Net operating loss. This is Amos versus IRS. The 11th Circuit Court of Appeals agreed with tax court, which means this case went from the auditor to appeals, appeals to tax court to circuit court. It went to the highest place on earth, and decision is this. The key issue involved around this CPA, the taxpayer, Amos, is actually CPA. And around it, this CPA inability to substantiate over $4 million NOL in the book. But this NOL didn't come in 1 year, it came in 15 years. So you remember statute limitation for IRS audit is 3 years, right? So why could they go on to 15 years? Yes, NOL can go on to forever because that NOL is landed on your today's tax form, so can be audited whenever is needed. So the CPA, the case is that Amos actually have more than, I don't remember, it's quite a few Burger King franchise that he's running. But he's also a CPA running a CPA practice. But he failed to produce original record to support the claimed NOL. The only document the taxpayer was able to provide were the tax returns and a carryover worksheet, which were deemed insufficient for substantiation. So the IRS challenged the legitimacy of those claims, arguing that without proper documentation, the loss could not be allowed. The tax court came in, the circuit court came in, and said that I agree with IRS. And you have to have documentation to support. So what does that tell you, ladies and gentlemen? When you have something on your tax return that coming from centuries ago, and you need to keep the record for that time, you cannot say that, well, here is my carryover worksheet, and without substantiate how that loss come from. So that is a new case. So with this, you understand how important that is to have a proper record keeping documentation to substantiating your claims, right? All right, next one. Palestine, Iowa. Palestine, Iowa has an incident happened back in February of 2023. The trains derailed in that area. So IRS issued a notice of 2024-46 determines that the payment made by the North Fork Southern, this is the company who runs the train, to individual physically affected by February 3rd, 2023 train derailment in East Palestine, Iowa, are tax-free disaster payments as a result of an evidence of catastrophic nature. So basically, they're saying that if you are injured as a resident and for these type of things, because it's evidence of nature going upon humans, so IRS say that you don't have to pay, you don't have tax burden on this payment you got. But the payment for lost wages and the payment to businesses were determined to be taxable. So you may be, as an individual, if you got injured, you might have one settlement, but it was two components. One piece is for physical injury, one piece is for lost wages. And you need to separate both. One is taxable, the other one is not taxable. This is what IRS issued on Notice 2024-46. And the settlement is taxable is another case. It's again talk about these kind of settlement. When you have these settlement, are they taxed or not taxed, right? So this is another Finnegan versus IRS. This is a tax court memo 2024-42. It talks about this estate. So Finnegan estate, so means that the taxpayer passed away, But a court case that taxpayer filed against a state for mistreatment is actually come back, taxpayer won. So there is a settlement from the state government to the taxpayer. But taxpayer passed away, so it went to the estate. And then the children come around, goes, that's not taxable. So that issue went to the tax court. So the decision, the tax court ruled that the settlement proceeds were taxable and it could not be excluded from the income of that deceased taxpayer. So it's included in the estate to be taxable. The court determines that the payment did not qualify for exclusion under the physical injury or sickness provisions of the tax code. There is a tax code 104A bracket A2, just call it 104. That tax code allows exemption for certain settlement that is for physical injuries or, things caused by sickness, depression. So that is, in this particular case, there is no allocation. The settlement has no allocation to that, so it is all taxable, right? So the decision highlights the importance of understanding the tax implementation of settlement. When you go through court proceedings, you have settlement. It serves as a reminder that the only certain type of settlement payment, especially those related to physical injuries, may be excluded with Section 104 from gross income of the taxpayer. So settlement in general is taxable. Remember, one of our webinars last Tuesday that I did is for the merchant account settlement payout, right? So I encourage you listen to that webinar, to log on to the portal, put your name in, put your merchant account in, so they will give you money back. That money is taxable. Not all the settlement is non-taxable. Majority of them taxable. But what about rebate? This is another announcement this year. IRS indicated that the amount taxpayer received from Department of Energy for home energy rebate program are not income. You should consider that to be a reduction of the price you paid for the home improvement. You got it? So the money you received is not your income, but instead it is the home improvement reduction, the amount reduction. So making sure that you understand the Department of Energy for home energy rebate programs is not taxable income. That is an announcement by IRS. All right. See, all these things are new, right? For 2024, it's so worthwhile to know what they are, because it just offers a better understanding of the system. And for me, when I look at these things, it offers me a trend, and I understand how things work. So when you come up to me and with a question, like nobody knows the answer, I have the answer just because I look at these cases and I summarize them up in my mind, and I know what need to apply to where. This is where literally what I am doing right now is to bring you with me, learn it together. Company benefit, not tax to employee. This is another fact sheet IRS produced in 2024, stating that the value of work-life information and referral services offered by an employer are generally exempted from taxation as de minimis rule. Okay? The definition of work-life referral services, a good example would be some employer to combat the depressions that existed with young people. What they do is they hired third party to provide counseling services to employees. So when you call into or getting the treatment, it's free to employee, but the employer pays for it. And ordinarily speaking, those money the employee spent would be coming back to your W-2 as taxable income, because it's almost like you made additional income to pay for that service. What IRS here, and on the fact sheet 24 to 213, and IRS was saying that these type of services, work-life related service, and we do not want that to be taxed on employee. Employer, you deduct that as business expense, but don't allocate that to your employee and charge them for taxable income. That's what that says. So I want you to be aware of if your company and actually providing some service like that, but moving that onto your W-2, you see that become a deduction for you. And if this is a new fact sheet come out this year, you can go to talk to your employer, have them study this fact sheet a little bit more, so they may not need to put that as your income anymore. Then you save some taxes, right? The next one is a forfeiture of IRA. Forfeiture, I wish I did a definition for you. And this is the word I learned, right? It's not like English is my second language. I'm not super good with these type of word. I only learned that when it is needed. So forfeiture basically is forced due to fault of someone to force that happen. So in this case, Hubbard versus IRS, the tax court memo 2024-16, the tax court determined that a pharmacist serving a 30 years prison term for distributing of controlled substance was taxed on the forfeiture of his IRA of about $400,000. So the taxpayer who is in jail and argue that because the $400,000 IRA was forced out, it was not his choice, it is forced out, then he believes that it should not be taxable to him. So the tax court ruled that the forfeiture of IRA was indeed taxable. The court reasoned that the fund in IRA were part of Hubbard's income, and the involuntary nature of seizure did not exempt it from taxation. Basically, I'm imagining, I didn't go into the case so deeply, but I am imagining that with the charges prison sentence, he also need to pay out some money to the victims or to the employer. Don't know who he pays to, but he didn't have it. But he has it in IRA. So the court had charged the involuntary force out of the IRA. So he might even be young enough that he's going to have early withdrawal penalties, income taxes, all of these things going to come to him. The tax court ruled that it is taxable. So the tax court referenced prior legal principles regarding the taxability of income derived from illegal activities, affirming that income, regardless of its sources, is generally subject to taxation. So that kind of gives you an idea, right? If you say that, well, the sky turned purple, so my IRA has to come out. I don't have any control, and I'm not willingly to do that. I am involuntary in that aspect. So should I be paying taxes? The answer is clear with this case. So now we know Hubbard, IRS, decision made, court says, absolutely, IRS, you are right. So he needs to pay taxes, even he's in jail. The next court cases is Bullies versus IRS. And this one went to the Ninth Circuit Court. The circuit court agreed of the tax court decision. And the tax court is dealing with the fact that the mom transferred money to the son. The tax court had previously determined that the transfers did not meet criteria for loans due to the lack of formal loan documentation and the repayment terms. So there's no amortization schedule, there's no interest, there's no document. So the court emphasized that in the absence of interest or repayment schedule further support of characteristics of the money transfer, then it is not a loan, it's a gift. The Ninth Circuit Court referenced previous legal standards and regarding the distinction between the loan and the gift, and reinforcing the importance of intent and the documentation in search and determination. The court agreed with the tax court, the lower court, for the characterization of the transfer to be gift rather than loan. The classification has significant tax implications. So you're probably wondering why? Because if it is a loan, there is no income tax involved, right? Mom loans to the son, and there's no income tax implications. But if it is a gift has threshold every year. Mom cannot exceed that threshold. If she does, she'll need to pay gift taxes. So it is very much tax driven. So see, mom give money to son, and very serious issue, right? I know some of you can relate. So this is a court case, get determined, finalized, made into a reference for all the other court cases or argument between taxpayer and IRS. And if you come into the same situation, you will pay because mom will pay. The son will get it for free, okay? Because it's a gift. Mom will pay gift tax if it is over that threshold. Every year there's a threshold, right? So 15,000, 16,000, and so there's only that much room to give free gift for the children. Next, travel expenses, deductible or not? Such a easy, understandable court case. Some of the court cases are coming in very transactional. They're not debating the principles of the tax rule and regulation. They're debating on the transaction. So in this case, Stewart versus IRS. So this case went from tax audit to the appeals, and it didn't work, went to the tax court. The tax court summarized the opinions under 2024-3. The tax court allowed this musician, the Stewart is a musician, and who contemporaneously documenting his travel mileages. So contemporaneously means if today he went to an event, he will write on the log that he went for the event and how many miles he drove and what does he do. So he does that when it incurs, not like some taxpayers claim the travel expense, the mileage, but they just go onto the Excel spreadsheet and do it after fact. So sometimes when we see audit case like that, our client do not have contemporaneous automobile log. In that case, we tell the auditor that our taxpayers do not have one. Would you like us to produce one for your review, for your determination? A lot of auditors, most of the auditors we work with, they're very reasonable. They understand to have a habit of contemporaneously recording something is not as easy as just doing it after fact. So they would take our summarized sheet, then give a deduction, whether allowed, disallowed, depends on the reasonableness, right? But in this case, this musician actually have these logs, but the log was destroyed in a fire. So he knows what the log total is, but he cannot show the auditor because obviously the total is already on the tax return, but the document was burned. In that case, the tax court actually allowed, the auditor allowed the deduction, tax court affirmed it. It's okay, and even though you lost it, it got burned, it is out of your control, so we are okay your deduction. But the tax court did not give the Japan trip the musician was making for so many times, because he did not do any performance and he didn't have any business purpose for these travel. So the not deductible portion is actually the air ticket, hotel lodging related to Japan trip. You see how that works on the travel? So if you are traveling internationally and you really need to have a documentation for business purposes, did you visit your other counterpart? Are you doing performance? You're a musician. Did you even play on the street to get some people to appreciate you? So you got to have a business purpose before IRS can say that, yes, it is business related, we allow the deduction. And I consider this is a very reasonable IRS court case. I mean, even allowed for the disappeared record. But the musician do have contemporaneous automobile log. That's really good. All right. Now, the next case I want to talk to you is loan versus equity. This is a one that has a little deeper understanding for the business owners. Just follow me. So this taxpayer and IRS disagreed. So the taxpayer was a sole proprietor. It's a sole shareholder, sorry. The Thomas Frey was the sole shareholder of two S corporations, Crown Disposal Inc. and also CR Maintenance Service Inc. So both of these, he owns 100% and is all S corporation. And the Crown provides financial assistance to CR Maintenance during difficult times because CR Maintenance is not doing very good. So the other S corporation, they're transferring money and directly paying bills on its behalf. And these transactions were recorded as a loan in the accounting record for both companies. So one has a loan, the other has a receivable. Okay? But it's lack of documentation to be loan. The primary issue was whether the transfers from Crown to CR were bona fide debit or should be treated as equity contribution. So if you have two S corporations and one corporation is paying expense, but borrowing money, so that expense is deductible, right? So one S corporation will run a loss on here. The other corporation, because it is a loan, so it is actually had a receivable on the other S corp. So this is how it was booked on the accounting record. But IRS is challenged that it is not a loan, it's equity. So what IRS wanted to do is your one S corporation should distribute that amount to the shareholder, not a loan. And you're going to issue K1, you're going to say distribution is this amount. Then the shareholder pay that amount to the other S corporation as equity injection. So basically you got distribution and you have equity injection, then you can expense them just as it was. So this is where that IRS is arguing whether you have the documentation to prove that is a loan between the company. So IRS argues that the Section 385 of the Internal Revenue Code precluded Mr. Free from recharacterizing these transactions as an equity contribution because they were recorded as loans. So IRS was saying that you booked as loans, but when you file taxes and you went into equity, you know why when they file taxes goes into equity, even though their book says it's loan, but the tax preparer moved that loan to equity. The reason is in S corporation, if you don't have enough equity, you cannot deduct the losses, right? So if you don't have basis to deduct the loss, all of these payments they made would have no place to go. It will be disallowed and waiting for you have enough base. So it is actually taxpayers' inconsistency at their accounting record versus what they filed in their tax return. So IRS comes around, goes, no, you said it's a loan, and you cannot put in the equity to deduct those. But the court actually did analysis and related to traditional debt equity factors and determined that the transaction and the payment were more likely than not constituted as debt. So instead, they were deemed distribution to Mr. Free and a subsequent contribution to the other company. So tax court goes, it doesn't look like debt. It doesn't look like a loan. You have no documentation. So we're going to put in the equity, and you are an equity, right? So that is the cases where the IRS's original thought was, this is not equity, it's a loan, so you cannot deduct your losses. But the court case coming in and looking at this goes, it is equity, not loan, because you don't have enough documentation to prove that is equity. But of course, the consequences is the other S corporation need to contribute that to distribution. If that distribution is over the basis, then the other S corp will trigger capital gain. Right? Not an easy one to explain, but I think that gives you an idea that if you have a two related company between these two companies, then you can be loan, you can be equity, the tax treatment would not be the same. All right. A new court case finalized. This is the one says cannot get away if you don't file returns. So this is a belt kick versus IRS. And the tax court determined a couple had about $7 million of non-reported income over 20 years period when they did not file tax return. And he also have a foreign bank account that he used to pay business personal expense. The court emphasized the importance of accurate reporting and compliance with tax obligation. So the taxpayer refused to cooperate during the audit process, so his reliance on frivolous law argument, tax court tax argument, were noted as a contributing factors to find against him. So the decision highlighted the consequences of failing to file and report income accurately, particularly in the case involving significant amount unreported income and self-employment earnings. So this court case, they have a foreign income and they did not report. So the IRS actually went in, got from the foreign banks information and assessed them for penalties. They know that that's coming, so they filed tax return. But they didn't file for all of these years, so they cannot get away from all these penalties: late filing penalty, late payment penalty, late filing, non-filing, late payment penalty, accuracy penalty, then with self-employment tax earning. That's a 15%. So they got close to $2.5 million tax due on this case. So what I'm trying to say to you is we got a court case right here, and it says that if you don't file your tax return, that is not a good idea. You want to file your return, file it correctly, file it completely, and don't try to let go of some area thinking IRS don't know. They really do know. And I can tell you why they know, and that would be another webinar. I can tell you how IRS do that, but they know. So make sure that you file your tax returns. The other one is nonprofit organization losing exemption status. Exemption status just means that these nonprofit organizations, when they made a profit, they are exempted from income tax. So this one is Ayahuasca Church of Healing, and this is a Iowa church in Iowa, and they lost their status. Let's see how they lose their exemption status. This is a court, they went to court appeals and this is being affirmed. So they don't have nonprofit status anymore. So the district court, the upper court, found the church did not meet the requirement of 501c3 because their primary purpose was to distribute and facilitate the use of ayahuasca, which is illegal without CSA exemption. CSA stands for Controlled Substance Act. So this ayahuasca is a psychoactive substance. Can be tea, can be a drink, and it is well known in the ancient time. So this is a substance that did not get approved by Controlled Substance Act, so they did not meet that exemption. And the court determined that the church's activity amounted to an illegal distribution and promotion of controlled substance. That's pretty serious. You know, 501c3 are the companies like United Way, Goodwill, and those kind of people. You donate into 501c3 and you can write off from your taxes a donation. Okay? A lot of churches are 501c3. So this one is also a church called Ayahuasca Church of Healing. And it kind of translated that substance name, right? And, spelled as Ayahuasca, Ayahuasca. The Church of Appeal affirmed this decision, agreeing that the church purpose and operation do not qualify for exemption status. So they lost that status. And because it is Iowa, you know how I'm literally, grow up in Iowa, so I pull it out. So this is a psychoactive tea, that definition of that. So ayahuasca is a psychoactive tea that originated from Amazon region. And this is a substance to do what? I haven't really tried yet, I don't know. But obviously the church using that for healing purposes, now their status is gone. And this is a final decision. So they would not be able to take free donations anymore. There's also others losing exemption status. So this is all, we're just talking about between January to June, right? So this is XC Foundation versus IRS. They also lose their status. Give me a second. So this one, IRS deny of the tax exemption status of the XC Foundation because IRS says that they don't have the their lack of jurisdiction to file case against the commissioner, against the IRS. So this XC Foundation must be not following 501c3 filing or whatever requirement. As 501c3, you have to file every year. If you didn't file for 3 consecutive years, you lose your status, right? If you lose your status and your petition to tax court for to delay the judgment and wanting to have your tax status back, and the IRS file a motion to dismiss for lack of jurisdiction, alleging that XC lacked the capacity to initiate such a litigation in the tax court. The IRS argued that dismissal of XC Foundation exempt status challenge was a proper one. So the court agreed with IRS. So they lost their nonprofit status because they didn't keep their good standing, the good standing status with the logistics. You need to file with the state. You need to file annual report with the state. You need to file with federal government every year. And even if you don't have any income, you still need to file. So they didn't do that. So whatever they do with tax court is not even being accepted. All right. The next one is all about documentation. This is the case that not complicated, and it just really needed to have a good documentation. I'm just looking at these folks thinking they need a good accountant and a good tax preparer. The case involved a dentist and his wife who owns over 20 rental properties. The IRS had to challenge certain deductions and the income reported related to these properties. They contended that certain income should be classified differently to reduce their tax liability. So, of course, the taxpayer and the tax preparer had done something to reduce their tax liability, but IRS challenged that position. IRS position is they were not substantiated or improperly claimed. IRS also challenged the classification of income, arguing that it should be reported as ordinary income rather than capital gain or other favorable classification. What is other favorable? That is like the passive income, right? Passive income, you don't pay self-employment tax. Ordinary income, you do. So IRS challenging that. So the court, the tax court, this one didn't go to higher court. This one is tax court. The tax court meticulously reviewed the evidence and found that many of the deductions claimed by the taxpayer were not adequate, is not adequately substantiated. What exactly that means is if they claim a $5, if they claim, say, $5,000 repairs, and tax court could not find the receipt that matches to that claim, the court agreed with IRS position on the classification of income. Not only the deduction, they don't have enough substantiation. On the income side, the court determined that it should be reported as ordinary income. Well, if one is dentist, the other one is managing 20 rental properties, would you consider the one who managed the 20 properties is a full-time job, is a professional job, or you think she just, a passive income? So the court decided it should be reported as an ordinary income. The tax court upheld the IRS determination and, made the taxpayer pay more taxes. The court decision emphasized importance of proper documentation. And this is the tax world. And anything you say, it is going to need to be substantiated by your record. You want to claim deduction? Give me proof. And reporting income, there's rules. And you cannot claim everything on passive income. And they are not passive when you are full-time involved. Without other jobs, it's hard to substantiate you are passive. Some of our clients, I wouldn't say a lot of clients, they are passive because they use a management company to take care of everything. All they got is a number at the end of the year. So they don't get involved with day in, day out. So they are passive income. They don't have to pay self-employment tax. But this particular case, because of the situation, the IRS believes, and they are active ordinary income, so the taxpayer get audited, went to appeals, and went to the tax court. The court said, yes, the IRS is right. So that's the court case. Manager, not liable for company tax liability. This is a court case. And this is Powell versus IRS. And it went to district court. And the Pennsylvania Federal District Court determined that the general manager of an auto body shop was not personally liable, as he was not an owner or not a director, not an officer. And this manager's this manager's signature authority was used only per direction of the owner, and in any event, he was unaware of the tax liability. So with that said, the manager not liable for company liability. If you ever get involved with audit, especially on sales tax for the state, on payroll tax for the federal government, and a lot of times you'll find the questionnaire the auditor asks you is to say who is managing the tax submission, who is writing the check, who makes decision to pay what, because they're trying to figure out who is liable. You might be liable as a partner, as a manager, even though you're not the director, you're not the officer, you're not the owner, but if you are the manager making all the calls, you are liable. But in this particular court case, of course, Powell is not liable because he doesn't even know they owe that much, and he also have the signature signed, but for the direction of the owner. It's coming from the owner say, go ahead, pay it. Go ahead, sign it. So that's what he did. So that's why he's not liable. But this gives you an idea, right? How do you know you are liable for some company doing, you're an employee of the company, but if you're the one knowing everything about the money and you just decided not to pay payroll taxes, you might end up be liable. So something to open your eyes and understand what you're facing when you are so important in the organization. Marijuana business. So this is an information release of 2024-177. The IRS reminded marijuana business that deductions other than cost of goods sold remain disallowed until federal regulation declassifying marijuana as a controlled substance. As long as marijuana is a controlled substance, and you can't deduct anything but cost of goods sold. You can make income. You say, well, I have salary to deduct. Sorry, you can't. So you'll pay taxes at a gross profit level, not a net profit level. So want to remind you. ERC update in 2024. This comes out from January to June as well. In a press call, IRS Commissioner Danny Werfel stated that during the suspension of processing new claims for employee retention credit, the IRS has disallowed 1/3 of processed claims and has a backlog of 1.4 million claims. It is 1.4 million claims. It's not $1.4 million, of which IRS suspected 70% have questions as to accuracy. I don't know how they came up with 70%. There was one time, and the commissioner said that 99% they were all inaccurate. I don't believe that. I think majority of the claim is accurate. But it's not hard to do employee retention credit. They're coming from your payroll record. How hard could that be, right? So really, just be patient. This is the update from, obviously they reduced the ratio down to 70. Don't know how IRS did it, but just so you know. The new FinCEN report. FinCEN report is everywhere, and you know that. But there is a new one coming up, okay? And then the FinCEN has proposed a new rule targeting non-financed transfer of residential real estate to legal entities under trust. So if you have a house paid in full, or someone buy that house with cash, but they're buying it on the company's name, or they're buying it on the trust name, it's not an individual name. Certain profession involved in the real estate closing and settlement would be required to file real estate report with FinCEN for covered transactions. The covered transactions includes both sales and a non-sales transfer, such as gifts transferred to trust without a dollar threshold. Okay, the report must be filed 30 days after closing date. This aim is to combat money laundering and increase transparency in residential real estate sector. Residential real estate sector are the houses, right? Bought under a business name, bought under some trust. So that is what they are doing. So this is coming. And for the closing companies, closers, settlement offices, expecting them to increase their service fee, right? They have to do these kind of things. All right. The next one is really rather important. This is one of the ones I looked and thinking, wow, we need to talk about it. Selecting tax preparer. In Marine versus IRS, the tax court memo 24-10, the tax court declined to overrule a decision from 2 decades earlier and held that a literal reading of the law keeps the civil statute of limitation open indefinitely upon fraud by the preparer, even if unknown to the taxpayer. So mouthful words, and what that means is the case addresses whether the IRS could assess tax beyond the standard 3-year statute of limitation. Remember, we always talk about 3 years statute of limitation. IRS right now are auditing taxes for 2023, 2022, and 2021. Okay, 3 years. And outside of 3 years, they cannot open to audit you. But this is the one that if it is related to fraud by the preparer. If your preparer was charged with fraud, the audit to you has no limitation because it is fraudulent tax return prepared by tax professional, even when you, taxpayer, is not aware of the fraud, right? So basically, this person, Marine, has a taxes filed by fraudulent tax preparer. The taxpayer is not aware of that, but the IRS can audit unlimitedly to charge you and have you pay for whatever long that was. There is no limitation. So the case highlights the importance of carefully selecting tax preparers and review your tax return, right? It demonstrates that the taxpayer can be held liable for extended period due to the preparer fraud, even if they are unaware of that. Sound very unfair, but that is how important. You got a tax court case already here, so if you get audited, you argue 3-year limitation because of your tax preparer is fraudulent, is not working for you. Those cases will tell you flat, you owe it, you need to pay it. All right, the last but not the least, the IRS, there is an organization parallel with IRS. It's called a taxpayer advocate. This is IRS, part of IRS, but yet not reporting to commissioners. So that way it can act independently from IRS, can help taxpayer to resolve IRS issue, taxpayer advocate. And in a tax tip from Taxpayer Advocate, the IRS warned that the artificial intelligence chatbot may not provide accurate and complete answers to tax questions. We had taxpayers using those documents as a base for them to do what they did on their tax return. So the IRS said that don't do that. And the taxpayer should not solely rely on AI-generated tax advice. That is why you need to come into a firm like Community CPA, right? So my last slides here is actually say that see me on Tuesday. On Tuesday, the coming Tuesday, I'll talk about tax planning because it has so much to do. We talk about all of these heavy lifting stuff, right? You got an earful of here and there, all these changes, all these updates, great information, but it's not strained into applicable things for you. So we will talk about tax planning. What do we do during tax planning? How we apply those knowledges to you or to different people. And here, and we also have our website. And if you click that appointment button, and you will see these partners list, and you can book any one of us for tax consultations. I take it back. Not everybody do tax consultations, but I myself and also Song, and we are two of us are into taxes, and the other partners are into other things that you can tell from here. You can book our time, and we come in. It is a paid click, so you click us, you book our time, you pay the fee that's stated on our website, but we come on Zoom to meet you. It's a video conference, and for me, and I actually use my whiteboard and draw things with you. English is my second language, so a lot of time I do rely on my drawing rather than just speaking. Right? I wish I can speak eloquently like those native, grown-up kid, adults, but no, English is my limitation, but I try to overcome that with visual. So when you come onto my video conference, and when there is a need for that, I do not hesitate to show you my whiteboard. And a lot of people save my whiteboard drawings. All right, and our last slide is to tell you, subscribe to our YouTube channel. And we are surpassing 6,000 followers. And you can be another one. And you subscribe our channel, you will get notifications every time we talk about a topic. And that would give you an idea of what we talked about. If you don't have time at 3 p.m., you can always come later, because we upload these webinars into our channel. So you can tap into the knowledge later. And our website, communitycpa.com, and you can email Catherine at communitycpa.com, and she is our everything. She take your input, so she knows what you need. She can schedule me for certain talk, and she also know my schedules, and so don't be afraid to tap into Catherine, and she's our marketing manager, so she handles everything. So what is not related to marketing? I mean, everything is related to everything, right? So our firm opens 6 days a week, and I actually just sent out an offer letter to a new professional staff who is joining our firm in August. And in my offer letter, I tell the newbies that we open 6 days a week. So he wrote back, goes, "What? You work 6 days a week? That's a lot of work days." And I told him that, absolutely right. I forgot to tell you that it's 6 days a week, but people work Monday to Friday or Tuesday to Saturday, right? Not really everybody working 6 days a week. Oh, yes, I work 6 days a week. So I'm the only one, because I have nothing to do but these work stuff I really enjoy. So I take that as my sport, so I have to do it, right? It's good for me. I will see you again on Tuesday. Remember, I will talk about how Community CPA does tax planning.